you as Annabelle as well.
You know, it's so funny. Every time I'm joining this call, I'm always thinking in terms of like, okay, I got to log in as host. I have to log in as host, and I forgot that Annabelle was going to be on this call. So don't mind me anyway.
Can't you change the name though? I'm sure you can.
Oh, I'm sure I can. Uh, you know what is? Or probably oh, you know what? I do have my own account. I just remembered. But I think what happened is because I logged in last time as you when I was hosting when we were doing the Tucson. We did the Tucson investments meeting last time, so I think it remembered me. You know what I mean, like with cookies and all that. So I think that's why it still thinks I'm multifamily Annabelle. So
Okay. Well, you don't look like me, so no worries. All right.
You're prettier, so that's good.
Oh, thank you. All right, let's get this started. So
All
I'm
right.
recording this on YouTube Live. So I just wanted to welcome everyone. My name is Annabelle Pacheco, and I host Multifamily Investing Call with Paul Krause. And every week we just interview multifamily rock stars, people that are creating some just incredible wealth out there for themselves and their families with multifamily properties. And really my goal and our goal is to interview people that are crushing it that in the multifamily space and pretty much have them share ins and outs of that space. And I want to introduce Paul Krause and let him introduce himself, a little bit about what he's done and what he's doing, and then give us a little market update, and then we'll bring Candace on board.
Yeah, hi everybody. So Paul Krause, and I've been in real estate since 2006. Pretty active right now in Arizona and in Illinois and Chicago. We have multiple projects that are in value add progress because they're kind of multiple step, multiple stage projects that are all of these are under 40 units. So these are what I would call like smaller, non-institutional size, but still, for a 2 or 3 person partnership, still a handful of work. So very active there, and just got another lead on another property in Arizona today, right before this meeting. So that's why I was a little bit late. I couldn't even believe it because our partnership had taken down a deal, last month that we are very actively engaged in not only leasing up right now, but also doing some cosmetic light rehab. So we're leasing them really as quickly as we can go. And that's been really, really exciting. So that's a little bit about myself, and I'll give it back to you, Annabelle.
All right, fantastic. And I know Paul is working extremely hard. I mean, I think, how many have you acquired in the last year? You've done a lot. Say it.
You know, 6, I think I closed, I think with various partnerships, we closed 6 deals last year. And then we're probably on track to do somewhere around the same, maybe 1 or 2 more. It just kind of depends. It's just funny because the minute you put a number on it, all of a sudden it changes because then like things just happen. So yeah.
Awesome. Well, thank you for being on the call. Thank you for hosting this call with me. And I wish you nothing but great. I mean, success on these deals, Paul. I know you've been working really hard. Yeah. So anyway, let's introduce Candace. She's with Astor Equity. I met Candace, I want to say maybe about 4 or 5 years ago, or was it longer than that?
I think so. That sounds about right. Probably 2019-ish.
Yeah, 2019-ish. And something about Candace that I was just like mesmerized is that she was just really good with numbers. And like her something about her, just, you know what, there's certain people that you kind of, you are attracted to, and you're like, wow, like she was so nice, and she was so willing and so open to wanting to help, and like underwrite, like if you need a second pair of eyes to help you. I mean, it was really, really nice of her. And not a lot of people in our space really do that or offer that, because it is time consuming. And, it just says something about the individual. And ever since then, I've just kind of followed Candace, and I see the stuff that she does. And Candace, her and two other ladies actually formed, and I'll let her talk more about that, but formed a group on Facebook, and it was geared towards women in the multifamily space, which honestly, I mean, it was a great, I think it was monthly, right? Like monthly calls. It was wonderful. I learned so much, connected with so many people, and miss it. I mean, I thought it was a wonderful thing to do. And I even told her, hey, listen, I'd be willing to help and get it going and get it running again, because it really was nice to connect with some successful women in the multifamily space. So anyway, I connected to Candace. I thought she'd bring a lot of value to our call today, and I want to welcome her. Candace, welcome to the call. And just, tell us a little bit about yourself. Give us a little bit about your background.
Yeah, sure thing. So, I mean, first of all, Annabelle, thank you so much for thinking of me for this. I'm honored to be here talking to you guys today. Do you mind if I share my screen? Because if I don't have a PowerPoint to go by, I get way off track and ramble. So I've learned my lesson, I have to have something to go by. All right. So I have an about me slide next, so I can tell a little bit about myself. But just so you know what I'm talking about today first, I figured it would be nice to just go through a real live case study of a deal that we closed about a year ago. I thought that's recent enough to be a recent acquisition and be fresh on, current market conditions or similar. But then at the same time, we've owned it long enough so we can really dive into like budget versus actuals and challenges we've had with the deal. And then I'll finish up with challenges in today's market in general, just overall, like what the multifamily industry is facing today, or in my mind, the three biggest challenges today.
Perfect.
So I live in Birmingham, Alabama. I've lived here for about 12 years with my husband and our two sons. We have a 6-year-old and we have an 18-month-old. As you can see in the picture here, this picture was actually taken a couple of months ago when we were in Alberta, Canada, hiking. So we love to travel. That's our passion. That's really one of our burning whys on why we got into multifamily, was we wanted that financial freedom and that time freedom you hear everyone talk about, but we wanted it specifically to travel and just experience the world together and have our kids experience, different cultures in different parts of the world. So we took several trips this summer, and this was one of them. It was an amazing trip. If anyone has ever been considering going to the Canadian Rockies, I highly recommend it.
That's cool.
So I'll rewind to 2012. I was a PhD student at the time in immunology, and changed directions in life and actually opened an electronics wholesale business in 2012. So at that time, we really were just living paycheck to paycheck with my husband's job. I mean, I had a very small stipend with the immunology program I was in, but we were financially not strong at all. So we got into this electronics business, which really took off. Never imagined it would grow into what it did. And we just didn't have a lot of competition in the Alabama market at that time. So we were able to operate on healthy profit margins for several years there before competition ramped up. So I've always been, very good about being frugal and investing and making sure we grow capital. So we were invested in the stock market at that time, all of our excess cash that we didn't need to reinvest into the business. So by 2017-ish, I was like, I really don't like the stock market. I want to invest in something more tangible, something I could control a little bit more. So I started reading a lot of books on real estate and different asset types. Eventually landed on multifamily after doing a couple of single families like everyone else. I thought that would be the easiest way to start, but quickly realized I couldn't scale fast enough. So by 2018, I was like, okay, multifamily's it. I'm 100% focused on multifamily. I'm going to immerse myself into the ins and outs and attend the conferences, read all the books, make sure I know all the people that I should know. And that's how I met Annabelle, is at a conference, and I think it was 2019. So today, fast forward to today, we have owned 17 multifamily deals as lead sponsor. I, along with my 3 partners, I have 3 partners on my team at Astra Equity. 3 of those have gone full cycle, so we're still holding 14, all of which are in Alabama. And then I also invest passively. So I have 7 passive investments, still always looking to invest passively if the deal makes sense, mainly from my 401k, since I can't invest that into our own deals. I'll recycle that capital into other people's deals. So I'm the co-founder and asset manager of Astra Equity, which I'll talk about a little bit, which each of my partner has a different role. And I think it's very important in a partnership for each person to bring a different strength and to have clearly defined roles. And we definitely do here at Astra Equity. So Jeremy is our acquisitions guy. I'm the asset manager for the team. Rich is our construction manager, and Stuart does a little bit of everything from investor relations, strategic partnerships, and just overall like business consulting, because he has a lot of business experience. He's owned multiple franchises, still does. And he really just makes sure that we're, growing the business the right way. And he double checks that we're doing things smartly. So we are hyper focused on the Alabama market. We're in Birmingham, Huntsville, in between the two along the I-65 corridor, Tuscaloosa, and select submarkets of Montgomery. We're very picky about Montgomery. But I think that's one reason that our team's been very successful, is because we've been hyper focused on one market. Obviously there's different markets in Alabama, but several markets we're hyper focused on. I'm local. I know the markets well. We've built out our teams here, and we know what we know. We know because we've done it multiple times. So I feel like sometimes people try to get into a lot of different markets and they're spread too thin, and they can easily make mistakes that way. So we're hyper focused. I think that's one big plus. We also have the clearly defined roles, which I think is another big plus. And then we work exclusively together. So we do every deal together, every active deal anyway. Obviously passive investments, we invest in different things, but I think that's important too. We're not jumping around to a bunch of different co-GP deals with different people. Like we're totally open to co-GPing with others on our deals locally in Alabama, but we all 4 work together on every deal. So we have been working together since 2020. So about 3 years, and we formed Astra Equity in January of 2021 after our 3rd JV together. So we did 3 JV deals together first to make sure that you just really don't know until you work with someone on a daily basis. You can have all the conversations in the world and you just don't know if it's going to be a good partnership, right? So we did those 3 deals together first before we decided this is awesome. We love working together. My husband calls us lightning in a bottle because I'm so lucky to find these guys.
How did you guys meet?
So Jeremy was buying a couple of, I think 4-plexes or something in Huntsville, and he was in town. He lives in Virginia. He was in town for either due diligence or closing, thinking it was due diligence. And he had heard of me on, I guess, Facebook or, social media networks, that it's kind of a small world in multifamily. So he contacted me and said, "Hey, you want to grab a coffee?" I said, "Sure." So we met up and talked about the market, and we ended up, what was supposed to be a 30-minute to an hour coffee turned into an all-day meeting, because we ended up driving to one of my deals that I was repositioning because he wanted to check it out. And then we ended up driving to another property that was for sale at the time to check it out together. And it's not like we immediately said, we're going to partner, but I started looking at deals with him, and he was already partnered with the other 2. So the 3 of them were already a partnership. And I started looking at deals with those guys on just like let's talk about this deal because I'm offering on it, you're offering on it. Let's share notes. And just one thing led to another. And we ended up saying, "Hey, you want to just JV on this together?" And Astra was formed about, I guess, 8 months later after we started JVing.
Nice. Very nice.
Yeah. So before I jump into the case study, I thought it might be wise to just throw in a quick slide on value, just in case anyone listening is very new or doesn't understand how a multifamily property is valued different from a single family. So the market value of a multifamily property is the net operating income divided by the market cap rate. So the NOI, that's a piece we can control, because that definition is income minus expenses. So income, in a lot of ways, we can control. We can push the rents up. We can increase other income. There's a lot of creative strategies for generating some other income not related to rent. We can increase the occupancy of a property. All of that will increase the NOI as a result. And then, of course, expenses. There are some expenses we have control over and some we don't have control over, like property taxes and insurance, which I'll touch on later in the presentation. But that NOI piece of that formula, we can control and we can increase. The market cap rate, cap rate is the rate of return, assuming it's an all cash purchase. So a 6 cap means you get a 6% annualized return. If you pay all cash, it doesn't take debt into account. Now that's determined by the sales comps in the submarket. So if you have a property that you're getting an appraisal on, the appraiser is going to look at, say the most recent 3 sales that are most similar to the subject property. And they're going to look at what was the net operating income when that property sold and what price did it sell for. NOI divided by price is your cap rate. So they're going to take those cap rates and average them and give you what is the market cap rate for that area. So we can't control that piece. That's controlled by the market. When we have a downturn, the market cap rate goes up because people expect a higher return on their capital. So we can't control that piece, but we can control NOI. So when you hear a value add deal, which is kind of a buzzword in multifamily, like it's a value add, everyone says everything's a value add, even though everything's not. But that's why we love true value add deals, because if we can control, the numerator of that formula there, then we can push the value up. And even if we have a downturn, even if the cap rate goes up for the market and we see value decrease, if we've been able to push NOI high enough, then we still have equity in that property. So it's kind of a recession hedge there. It makes sure that you still got equity in the property even if the market has gone down. Okay, so I wanted to talk about this deal because we've owned it a year. So I figured it would be good to kind of compare where we thought we would be and where we're at today. And this deal was a pretty tough deal from the start in terms of resident profile. So this deal, we did do a syndication on this deal. It was a 506B syndication from exemption from the SEC. So we raised capital from investors and 50,000, minimum and up, from individual investors, which a lot of our deals we joint venture or we just use our own capital. But this one was our first syndication that we did. We've since syndicated another deal and we plan to syndicate more in the future. So this property was 87 units in the Birmingham MSA. It was about 35 miles south of downtown, so really right on the outskirts of the city. Very rough property when it was presented to us. When we did our due diligence, when we did our physical unit walks, I remember we were all just kind of down. So we were like, whoa, these living conditions, the tenant profile is way worse than we expected. The delinquency had to have been higher than the seller was showing, or we thought at that time, just based on what we saw. We were like, there are definitely some drug dealers living here. We're gonna have to get out, and the area is not bad. So it's just the property, the property management company just wasn't screening tenants and was just letting anyone in. So we knew that there was a value add component here. We would just have to do a lot of hard work to get there because we thought we were going to have a ton of turnover at the property, having to kick people out and evict people. So here's a few fast facts about the property. It was right around $70,000 per unit on the purchase price. It was built in 1999, but when you see pictures in a second, you'll think
Candace,
70s. Yeah.
Sorry to interrupt, but is 70,000? Is that a market price? Is that under market? Can you describe in terms of pricing? Because I've been to Birmingham, I've been to Hoover. I'm not sure where this is exactly, but just so we have a reference of where 70,000 falls in the world of Alabama and Birmingham.
Yeah, so 70,000 is definitely on the low end. This was discounted because of the condition it was in, because of the resident profile. But this deal is in, if you're familiar with the area, in Shelby County in Montevallo. Are you familiar with Montevallo, University of Montevallo?
Yeah, I actually went to a bunch of the colleges, and I even went to University of Alabama in Birmingham, just because I wanted to see if there was any opportunities for us, because we like, we like student housing, we like combination of people who work at these large universities, because some of these universities are very large employers.
Mm-hmm.
So we like anything that looks kind of like high demand, very, very magnetic kind of leasing activity, very easy to lease. So I did travel through it, but I only traveled through it once. So I'm familiar with everything you're saying, but could I drive through it today? Probably not.
Right. Well, it is a discounted price. So
Yeah.
I would say the average for like a B class asset in the Birmingham MSA is probably between 100 and 130 a door.
Thanks for telling us that. Thank you.
Yeah. So this one being on the outskirts of Birmingham, you would expect a little bit of a discount, but not this much. We could resell this now for 90 something a unit easy. So I would say for this market, you'd probably, this sub-market of Birmingham, you'd probably see 90s. But in Hoover is actually where I live personally. 120 a door is most common for your 90s, even 70s, really. You see a lot of 1970s and 80s for the 120s per unit here in Hoover.
And for anybody who isn't familiar with what's going on in the South is absolutely a great location if you haven't done a deal to look, not only because, well, you have Huntsville in Alabama, which is blowing up like crazy because of the defense industry, but the auto manufacturers and the battery factories, the electric battery factories for Kia, for Mercedes, for Ford, between Memphis going east all the way to Alabama is a no doubter. So just FYI.
Yeah, I'm so glad I live in Alabama. I was lucky to just happen to live in a great market. So I'm able to be the boots on the ground and actually buy local. Love it. And we can get cash flow here, unlike some markets. A lot harder to cash flow in some of the hotter markets. So let's see where. So what 1999. So yeah, it looked like it was from the 70s. You'll see that in a second with all the green carpet and counters. And I have no idea who designed this place, but they were crazy. And so here you can see our projected returns. We projected an 8.7% cash on cash return over 5 years. For those of you who aren't familiar, cash on cash return is the annualized return from your cash flow only. So whatever money we will distribute quarterly to our investors from the cash flow, that's what that number comes from. And then our IRR and the AAR not only takes into account the cash flow from the property, but also the sale proceed, profit on the sale. And then of course, IRR also takes into account the time value of money and assumes that you reinvest your distributions at the same rate of return. So we had projected a 5 to 7 year hold with this asset. Really any of our deals that we don't plan to hold super long term, like we have some assets we plan to hold for a long time that we just self-funded, but any syndication deal, we typically say 3 to 7 years because our business plan will be complete in 3 years. If all goes well, a 3-year plan, we'll start looking to exit, but if maybe the market's, just not hot enough at that time or the market's down, then we'll, keep reassessing. Does it make sense to sell? Does it make sense to sell? And maybe that goes all the way to year 7. Most of our debt we have is either a 7 or 10 year term. So we usually have that flexibility to not be forced to sell or refi. We also always look at, around year 3, does it make sense to refi? Maybe we can return all our investor capital and continue cash flowing. And if it's a very solid asset and a great submarket, then that's something we always look to do. We just don't actually underwrite for it because we don't want to overinflate our return numbers. I know a lot of operators underwrite for refis, but it's just not, we look to do it. We just don't want to assume we're going to do it because it's a very unpredictable variable. Is there anything else? I don't think there's anything else I wanted to say there. Like most other syndications, you see we offered a 7% preferred return, and then we split the deal 70-30 after the 7 pref was paid.
So Candace, you you definitely talked about some of the challenges with the the neighborhood condition and things like that. But you also said prior to that this was a tough deal. Was it just because of the condition? Was it because of the management? Like, what else was tough about it? Was it the financing? Can you share a little bit about that?
Well, the deal, so when we originally underwrote the deal, we assumed that we could operate this at a much higher occupancy, and we were a lot more, I guess, we assumed it was more stabilized than it actually was. When we did our due diligence on the deal and walked all the units, I still remember us having lunch, and we were just all so down, and we were just like, what have we done? Like, this deal is way worse than we thought. Well, we went back to the underwriting and changed the numbers to reflect, a higher delinquency, a higher vacancy. And we came up with a plan with our property management we're going to clear out one building at a time to get better tenants in. And the deal still worked. I mean, as you can see, the return numbers are still super high here. I think we had originally split the deal like maybe 60-40, like more in our favor. And we had to pull back on splits to still get these returns. But anyway, the deal still worked. So we moved forward. But then actually when we got into it, the resident profile is still bad for sure, but we actually didn't have to completely kick out all the residents like we thought. Most of them were actually paying, even though they weren't the residents we wanted. So we were able to change our plan a little bit and stagger it to where we just sent non-renewals to certain groups at certain times, not like clear a whole building at one time. But basically, it wasn't as bad as we thought it was going to be. And we actually, because we went back and changed the underwriting to be much more conservative, we've been like blowing our projections out of the water. Like, this deal is, I have a chart here in a second. I can skip to it. Let's see. You can see here on this chart, the budget versus actuals. The dotted lines here are budget numbers, and then the solid lines are our actuals. The green being income, the middle there, the gray being NOI, and the bottom being expenses. I mean, you can see the income, our actual income has been way higher than we underwrote for, because we went back and made all those modifications because the due diligence scared us. So we've actually been able to overperform there. Even with some expense overages, we're still beating on NOI. But I can talk about some of those challenges in just a second with like the construction budget. I just threw this slide in there in case anyone wants to see really how the breakout is of our total all-in cost. So for this deal, all-in cost is right around 7.6 million. What we typically do is we underwrite for $1,000 per unit in operating reserves. And then your higher risk deals will add an additional reserve on top of that. So that's what this interest reserves is right here. And that's like to cover the debt service, because the deal is at risk of walking on thin ice, I guess, for the first few months as we go through the renovations. So the 113,000 is additional reserves in addition to the 86. Our CapEx budget here was 992,000, which comes out to right around 11,500 per door, which was not enough. That's one of our challenges. We are definitely going over budget there. But luckily we've had excess cash flow way above and beyond what we underwrote for. We're still able to give our investors what we had projected and hold back some of that excess cash flow to finish out renovations. Then here you can see our debt, some facts here on our debt. This was a local bank loan. We really like local banks. I think they're underrated in the multifamily industry, especially for smaller, less than 100 unit type deals. They really make sense in our mind, at least. For this deal, we had an 80% loan to cost loan, which wraps in the renovation funds in the loan. It's 30 months of interest only, 4% interest rate, which is crazy to think that was only a little over a year ago. So much has changed. This was a 7-year term, no prepayment penalty, as in all of our local banks and credit unions that we've worked with here locally don't have a prepayment penalty, which in my opinion is the biggest bonus or biggest advantage of local banks. But it is a full recourse loan. So anyone who doesn't know what that means, recourse means if things got really bad, we were not able to pay the mortgage and they foreclosed on the asset, and the asset was worth less than the loan amount, then the bank would be able to come after our personal home or any personal assets that we own. So a lot of operators don't like recourse debt. They think it's risky, but for us, at least, we felt comfortable because of all the safe holds we had in place with reserves, and we all have personal reserves we keep as well. So we feel like if things got super bad, then we have it covered. We'd never let it actually come to that. So like I said, we really like bank debt, mainly because of that no prepayment penalty. It gives us the flexibility of exit. So agency debt, Fannie Freddie, is what you probably hear operators talk about the most, or that's kind of their preference. Most operators prefer agency debt for any stabilized deal because it's non-recourse mainly. But with agency debt, you have a prepayment penalty. So if you want to say the market's super hot at year 2, you want to sell, you can't because your prepayment penalty is too high, especially with yield maintenance. Sometimes those prepays can get super crazy high and you just can't exit. So that's one big benefit to us of local bank debt. The second benefit is the construction loan aspect of it. We're able to wrap those construction funds into the loan rather than having to raise them all up front. So it's, lower cost to close. And then finally, the local banks are just a lot easier to work with than agency. We've done both, and agency can be a pain sometimes with the third-party reports and making you fix a lot of stuff that's found during the inspection, and their insurance requirements are higher and fees to close are higher, and just overall, you don't have that one-on-one personal component you do with a local lender. But then, of course, agency has its perks too, which non-recourse being the main one. 30-year AM versus 20 to 25-year amortization for the banks. And a lot of times you can get a longer interest-only period with agency. We had 2.5 years on this deal, but with agency, a lot of times you can get 3, 4, 5 years or more. You can just see a classic unit here on the left, and then what they look like today. We did our typical B- class renovation with vinyl plank flooring, black appliances, faux granite countertops, and plumbing, lighting, and hardware package throughout, and really changed the look of they loved green at this property. Whoever designed or developed it loved green. Even on the exterior, you can see green shutters, green railings.
Yeah.
So we changed it to like a dark gray theme. A lot of landscaping cleanup was needed here, a lot of overgrown trees, and you just couldn't really even use the common areas at all. Had to replace some roofs, lots of rotten wood. I don't have pictures of the back decks here, but the back decks were very unsafe. We had to replace a lot of them. That's what it looks like today. You can see we installed a little dog park, and we have a grilling station, which isn't pictured here, but we installed a grilling station for the residents as well. But just kind of to sum it up here, our income so far, a little over a year in, is by far beating projections, mainly a result of us going back and changing the underwriting when I guess we didn't have to do that after all because people are actually paying. Our expenses are over budget. Inflation hasn't worked in our favor like everyone else's. And then property taxes and insurance have been the biggest struggle across our entire portfolio, as I know it has been for a lot of others as well, especially in Texas. I know they're struggling with that. But the end result was the NOI. We're still able to beat projections right now. We've been able to cash flow a lot higher than we projected, which we ended up needing because we've been able to use the extra cash flow for the renovation overages. The property condition was just a lot worse than we expected. Even walking every single unit, there's just so much you can miss when a property has been neglected for years, and they just weren't answering work orders, and there was a lot of subfloor issues and just overall negligence that we had to go in and correct. So we're definitely going over budget on the renovations. I think we're going to be about 20 units short, which sounds like a really big number. It's only an 87 unit property. We just had a lot of surprises here. But luckily, we already have those funds and excess cash flow that we can roll over. And that assumes every tenant leaves, which is never the case. You always have some tenants that are going to renew at your renovated rents, and then you just end up selling it before you have to renovate the unit. So I think we'll be fine here. But this is, I believe, this property of our entire portfolio, I think, has gone the most over budget on renovations. And then any excess cash flow that we didn't need to renovate, it'll just be distributed at the sale. So we've still been able to meet our projections for investors on the cash on cash return. So we were all in at right around 7.5, 7.6. And we had a broker come to us and give us a valuation a few months back, and it was right around 9 million. It was like 9.5 then, but I just assume it's dropped some because of interest rates continuing to go up.
Mhm.
Like all multifamily assets, the tax benefits were great. We got about a 70% paper loss on K1s for investors the first year. So last year for 22, when there was still 100% bonus depreciation, if our investors invested, say, $100,000, their tax return showed a $70,000 loss, although they were cash flowing at greater than 9% average annual return. So, or, annualized cash on cash return, I should say. So can't beat the tax benefits of multifamily. And then one reason I just really love this deal was because, we have the long-term debt, we have plenty of reserves, and it was cash flowing day one, even though we thought it might be very thin on the cash flow out the gate because of the resident profile. It was cash flowing day one. All these things combined, it's as recession resistant as possible. I feel like nothing is ever 100% recession resistant, but we feel very safe with this deal during any downturn. We'll just keep cash flowing until we're on the other side of it, and then we sell.
Mhm.
So wanted to talk about challenges in the market today, because we all, I'm sure, feel the change, right, in the market today versus a year ago. The biggest changes that I see affecting the market, at least in Alabama, and I know for sure in Texas, because I have a lot of friends in Texas, are insurance and property taxes. Insurance has absolutely gone crazy. So we just had a property renew last week that tripled for no reason. We had no claims. This was a 40-unit property that we bought back in 2019. We had recently refinanced it to agency debt, and our insurance was about $18,000 a year, and our renewal came in at $58,000 a year. So I mean, these things you can't predict. We had no claims, no prior claims at all, not even the previous ownership. It's just, what do? We only had one company even willing to quote it, so you have no choice but to take it. So that's a challenge, because there's $50,000 of our cash flow just poof with one insurance renewal. Luckily.
Yeah, Candace, not to cut you off, but in every state that I know that we're operating in, the problem that we're having in the insurance world is that there are insurers that are leaving that used to be reliable in the smaller, especially like this is a good sized property, but anything under $25 million, I kind of consider like a smaller non-institutional kind of investment. And insurers across the country have decided to leave the market because the amount of claims has been, it's been impossible for them to be able to predict into the next year. So we have found the exact same thing going on, and it's absolutely so critical, like what you described, that now we're starting to underwrite buildings with a way higher insurance number, just because state auto, which is one of the ones we used in Illinois, they just decided, hey, we're not going to write any more insurance. Nationwide in Arizona did the exact same thing, where they said, we have all the risk we want, we don't want any new risk. So they even if you were a customer, you could not get more insurance.
Right. Yeah, that's the same thing happening here. So our insurance broker said the same thing about Nationwide, that they're not writing any new business in Alabama. They had so many claims from the storm seasons the last few years that essentially, I think, they were afraid if they kept writing new business, not only would they take on additional risk, but it would take from the buckets of money that they might need to pay out all these claims if we have another bad storm season. So Nationwide's not writing any new business. There's several other carriers that have said, we're just not writing 70s and 80s properties anymore. Yeah. So any 70s and 80s assets we have been non-renewed by those carriers. And anytime you have to go out to market for a new policy rather than just a renewal with the same carrier, it's, in our experience at least, it's always way higher. I don't know. The market's just so different than it was when we took out these policies. So you're right. I mean, there has to be something done. It can't continue. I mean, we've had other assets that have doubled in premium. The tripling was the worst so far. 2023 is still young, yes, but it's been a shocker for sure. We're actually looking at a master policy right now that we have until the end of the month to decide. And I'm still running some numbers, figuring out which properties we might want to add and all that. But that would not necessarily solve our problem from a price standpoint. It would be a little bit of savings there. But the main thing for us is it would remove some risk of volatility, remove the risk of non-renewal on future renewals, and it would supposedly lessen our chance that our premium could do something crazy like double or triple. It's still some increases, but I'm waiting on that data from the broker as well on the chances of that master policy premium increasing more than like X% a year. So hoping that helps with the insurance. But it's definitely a challenge.
Insurance? Do you have different insurance policies or different insurance companies for different properties, or is it the same company for all the properties?
No, so we use an insurance broker, the same insurance broker for all the properties, but no, he goes out to like 35 plus markets and different carriers.
Okay.
So for each property, we have a different carrier that insures it. It's just the broker that helps place the property with different insurance carriers. So I know like Nationwide, they're big on newer assets. So a lot of our like 1990s and newer, especially 2000s and newer properties are with Nationwide right now. But then your older properties, you only have a few that even want to write it. So it's different for each. Now with the master policy, it would actually be two carriers, kind of like two master policies. One carrier would insure all of the newer assets, and then one carrier would insure all the older assets. So like 80s and older would be placed with one carrier, but the two carriers would work together under one umbrella, like one coverage umbrella and one GL umbrella to provide us the master policy.
Mm-hmm.
You know, Annabelle, there's no benefit to the insurance company to do portfolio insurance anymore. It's to their benefit to have individual policies on every single building because they can charge more. And, you know, when you have a risk pool where you have people paying so little based upon, let's just call it 20 years ago, right? And then you have these fires, like look what just happened to Hawaii and Lahaina. Those fires wiped out an entire town. And there was a lot of commercial real estate that just got wiped out. It just burned down to the ground. That's going to be into the multiple millions. Now, I don't know who owns that or holds that risk, but when you have those kind of losses, the insurance companies, the way they operate, they can't sustain big multi-million-dollar losses year after year after year if you have a risk pool of people who are basically paying based on rates, you know, prior to like 1995 and 2000, right? So the people that come into the market after that, like ourselves, where now it's 2023, we have to be the ones to bear the cost of that in order to make that risk pool such that there's still enough liquidity to pay out losses in the event that there are major losses, while at the same time being somewhat competitive where, you know, there's a way to insure these buildings, because the truth of the matter is it would destroy the industry entirely if there was no way to insure the asset, because then no lender would ever consider giving you a loan. So it's this really oddball relationship where you have to have the insurance for the lender. You have to have enough liquidity in the marketplace to cover all these losses. But at the same token, you have to have a risk pool that brings in enough cash, and in order to have there be, you know, carriers like the carrier that we're seeing now is Honeycomb. They seem to be popping up in several states, and we took a policy with them. Berkshire, I think Berkshire might even own them. I'm not even positive, but Berkshire Hathaway also has an insurance company that seems to be stepping in. So it's a very real challenge that we're talking about here. Candace is dead on that you have to look at that differently in your underwriting today.
Mhm.
Absolutely. And when you take into account underwriting 3 times the insurance we were underwriting a year ago, plus underwriting higher property taxes than our previous models, plus underwriting a 7+% interest rate, no deals are working right now for us, at least in Alabama. It sounds like in is it Arizona? You said that you have a deal in the works right now. It sounds like that maybe I think Arizona is ahead of Alabama in that it had a cap rates go up and now there's deals available. Whereas Alabama, we haven't even felt the difference in the market at all until a couple of months ago. And then just now we're starting to feel the softening a little bit. So maybe there'll be more deals and more distressed sellers later in the year. But at least for right now, any deal we're being presented, the price guidance is just way above what we can even offer. So I anticipate the next few months to be pretty slow for us. For the first time in years, we don't have anything under contract right now because these 3 factors right here make it difficult.
Well, and that leads to the next question, which is when you're underwriting a deal, Candace, are your parameters in terms of what the market will bear in a particular neighborhood for the buildings or building that you're buying, are you looking for a particular percentage increase in the rents, or or is it that you're just looking for the per unit, the value add, so that by the time you get done with the work, that you can go from 70 up to 105? Like, what parameter is it that you guys are using or relying upon more?
So we look at the 3 metrics: the cash on cash return, the IRR, and the AAR. And we want to see at least, depending on if it's an A, B, or C class asset, this would vary a little bit, but I'll just say an average of, say, 7% cash on cash return and a 15% IRR and maybe like a 17% AAR. Lower if it's a B plus A asset, higher if it's a C minus asset with higher risk. But those are the parameters that we look at. So even if it's not a value add deal, say it's a stabilized deal, as long as we can hit those metrics, then we're interested if it meets our criteria, from an area standpoint, size, and just mainly overall class of the property. Like, we don't look at anything older than 70s, and really now we're more interested in 90s and newer because of this insurance struggle. But that's what we look at. Now, when we're underwriting today, like I said, we're having to underwrite for insurance 3 times as much. Property taxes, for the first time this month, have been a challenge because assessments came out. And for the first time ever in our county, Jefferson County here in central Alabama, where most of our properties are located, the assessed values, a lot of them came in a lot higher than our purchase price. So in our underwriting, this has been a rule of thumb for years. We've always done it this way. We've always actually beat on property taxes. Like, our underwritten number has been higher than our actual number on everything up till now. But in the past, we've always underwritten for 80% of the purchase price times the millage rate times the 20% assessed. I won't go through the whole formula, but now we're having to change our underwriting to 100% of the purchase price. And even at that, we may have to protest some. We are protesting some this year. So this is new for us. We've always heard people in other markets complain these last couple of years about property taxes have gone up double. Yeah, Texas for sure. I'm passively invested in a few different markets in Texas, and I know it's a big struggle there. And I've always been able to say, we don't have that problem in Alabama. We're beating on property taxes. Well, here it is. Now they've come in and they're on average 36% higher than last year, which nowhere near the struggle of insurance, but still you add it with insurance, and it's something we have to pay attention to going forward and make sure that we adjust underwriting accordingly. And then of course, interest rates, when you're underwriting a deal at 7+%, you've still got a cash flow and sellers just aren't adjusting yet. So there's that disconnect. It's just hard to make a deal work right now with these 3 things combined. And I'm sure you've heard in the news, the foreclosures in Texas, and I've heard one in Arizona and California, where these operators have taken out variable rate loans, Freddie floaters or Fannie floaters, as they're called, where, their interest rate can float up as interest rates go up. And it's made a lot of operators get in trouble. Some didn't buy rate caps at all, and some bought rate caps, but didn't take into account that their escrow for the next rate cap was going to also increase with the market. So that's caused, it's caused a lot of deals to struggle. And I think the challenge for us with this, which all of ours are fixed rate, we haven't personally been affected by variable rate financing. Luckily, we didn't have any variable rate finance deals. But our investor base has invested in some of those deals. So we have noticed a change in investor sentiment where, they've lost their money in those deals, or those deals aren't distributing because the operators didn't underwrite correctly and didn't take into account this variable rate financing piece. So then they're like, I'm kind of, gun shy about multifamily because I haven't been getting distributions, or I lost my money, or, So we have noticed, if we were able to raise $5 million before, maybe we can only raise $3 million now, because I've just really noticed, or we've all really noticed, a change in investor sentiment. So we're definitely looking to partner up and co-GP with the right people that can help us on an equity standpoint, as well as help from an asset management standpoint, just because my capacity is obviously limited. As I'm currently asset managing 14 deals, and as we grow, we're looking for help there. So I'd say that's what's next, I guess, for my team, is to just really start those strategic partnerships going forward. People we can partner with multiple times on multiple larger assets. So anyone that's interested in Alabama from a passive investor standpoint, definitely contact me. From a co-GP standpoint, love to have a call with you and to see if it might be a fit as we grow into larger assets.
Perfect. Great.
And there's my contact information. If anyone wants to email me, or you can visit our website. We have an investor portal there as well. We'll be notified that you signed up, and we can reach out.
Cool. So I have a quick question before we end this call. What would you say to someone that's looking to invest for their first time, and really in this market?
In the Alabama market specifically?
Well, you're Alabama, so yeah, let's say Alabama market.
Yeah, I would just say definitely do your due diligence on the operator. So as a passive investor myself as well, I have reviewed, I would say, at least 50 deals over the past year. I still have capital in my 401k that I need to place. It came back from an investment that sold, and I have it in a 5% money market fund, that I haven't reinvested it, because all these deals I'm looking at, to me, they're too aggressive for where we're at in the market, and I just don't feel comfortable. Also, with all these deals failing and all these partnerships breaking up, I'm a little gun shy myself with investing with someone else. I wish I could just invest it in our own deals, but I can't because it's a 401k. So I would say to anyone looking to invest, really dig into who the operator is. You always hear the operator is more important than the deal. The deal is important too, but you have to have the right people running the show. So make sure they're experienced. Talk to their passive investors for several of their last deals. Ask for that, and make sure it's not a friend or something that they're recommending. You want to make sure that it's truly a passive investor, and ask them about their worst performing deal and where that stands. I think a lot of times, even I presented a deal that was a success, right? I'm fully transparent. We have 17 deals we've done, 3 that sold. We have 14 deals. One of the 14 deals is missing projections by half a point. So I have one. Did I present that one that was missing? No, but I'm transparent about it. So I think what's important is that you ask that operator to talk about their worst deal and why, and what the actual numbers were versus what they projected, and make sure you feel comfortable about that transparency. Because I feel like, especially in the social media age, everyone paints a rosy picture, and they don't really tell the whole truth sometimes. So you got to do that digging and make sure you know who you're investing with. And then as far as the deal itself, really depends on your criteria and risk tolerance. So, I mean, I'm not going to say don't invest in 70s assets because they're more risky, because 70s assets should bring a little higher return than 2000s assets. So maybe you want to take on a little additional risk for a potential higher return. So I can't really narrow those kind of pieces down. But I'll end with this from a deal standpoint. Things you want to make sure you check is your organic rent growth year over year. So say the rents are $100 under market and they're going to push rents $100. Great. But then also look at that organic escalator that they're applying year over year. Are they assuming in addition to that $100 bump, they're also going to increase rents 5% a year, 4% a year? You know, what is that number? Anything over, depending on the market, but anything over 2 or 3% really scares me and would immediately turn me away. And really anything, we don't even underwrite for any organic growth the first year right now, because I think if anything, we're about to go into flat rent growth for a little bit. So look at that, look at your exit cap rate, make sure that that's conservative. So try to understand the market cap rate of the area the deal is in. And we always take off 10 basis points per year of the hold. So if it's a 6 cap market going in, and then we're exiting at a 6.5 cap. So it gives some cushion there in case the market were to get worse. And then everything else is pretty self-explanatory. So I could talk about that for probably another hour on everything you could look at, but hopefully that answered your question.
Well, I think that's great. I mean, for anyone that's listening and that'll probably see this, I've always, and I think I always bring that up. It's, you know what, really do your due diligence on that partner, on that operator. I mean, you need to know what they've done. You need to know, you know, where they're at, and just kind of look at the whole thing. Don't just look at the property and the numbers. You look at everything. So it's, I'm glad that you said that, and it just reaffirms what I believe. And, you know, and then we have, I'm sure you know a lot of people in the industry that you can always connect with. And it's just, you know, multifamily space is big, but it's really not. And everybody kind of knows everybody. So it's very easy to ask someone about someone else that's currently, you know, raising money for a deal, and you can for sure get a lot of information from people. So thank you. Any questions before we actually end the call? Are we all good? Everybody got it?
That was great. Thank you, Candace.
All right, Candace, I really, really want to thank you for coming on and sharing some time with us and enlightening us with some great information. And I hope that you inspired someone on this call. And I mean, I'm sure, I know you inspired me, and you always do. You really do know your stuff, and I love hearing that from you. And just, you know what, thank you very much, really, for coming on and spending some time with us.
Yeah, absolutely. Happy to be here. I enjoyed talking about my deal with you guys. And I do just want to end with, if anyone is looking at a deal to passively invest in Alabama and wants my feedback, I'd be happy to look at it for you. I know the market well enough to where I wouldn't have to spend a ton of time on it. I can give you some feedback. Other markets, it would just take too much of my time probably to look through. But if it's a passive investment in Alabama, happy to help. My email is here on the screen.
Perfect. And you know what? That's how I met Candace. We met and she offered to underwrite. Well, back in those days, you were open to underwriting deals anywhere, or like giving a second opinion.
Well,
but now,
yeah, well, my time is a little bit more thin than it used to be. I acquired a few more assets since we talked.
I respect that. Thank you so much, and thanks for everyone that joined the call today. Again, we host this call every week. It's on Wednesdays, 2 p.m. Pacific Standard Time. Don't miss it. Come back. Thank you so much, Candace and Paul. Thank you, Javier. Thank you for joining. Lumel, thank you for joining. We'll see you guys next week. Take care. Thanks.
Thanks, everybody. See you.